Good afternoon. Thank you for attending and welcome to this event of the role of emerging countries and their central importance in achieving our global sustainability goals. This meeting is organized by the Spanish CFA ESG Committee. In this committee, we want to promote sustainable investment in the investment professional industry and also the certificate in ESG investing. The certificate aims to deliver the investment knowledge you need in environmental, social, and governance matters. Let me show you a brief video of it. You can tell me that wasn't brief. Related to the conference, first let me show you some housekeeping stuff related to the meeting. We are recording this event, and please take into account that you can make questions directly in the chat or to me. Today, we have a special guest. It is with a special excitement that I am pleased to welcome Tim Love to our sustainability conferences. Tim is an investment director and responsible for the emerging markets equity strategies for GAM investments. He will be talking about the importance of sustainability in investing in emerging markets to get superior risk-adjusted returns. Also related to the huge relevance of the emerging markets in achieving global sustainability targets and how active engagement is essential for stock picking. So Tim, it's up to you.
Okay, many thanks. I will keep this presentation to 35 minutes max and open it up to questions. There's quite a few slides to go through, but they're more informative than they are in terms of being full slides in their own right. I think the point that I'm going to make on ESG is that there's a need to set the scene for emerging markets. There's a need to understand both the contradictions within E, S, and G, and how those contradictions play out in 35 different geographies, different regulatory environments, with data, as an example, being remarkably different in its treatment in GDPR, US, or in EM autocracies. So by definition, this is a heterogeneous asset class, 30 plus countries, 60% up and down in currencies each cycle, and with fundamentally different E, S, and G parameters. So there's a lot of inherent contradictions within the asset class, but there are ways to bring some conformity and some normalization to an investment process. And that's depending on the philosophy that you take. A repetitive alpha generative process is the one that we would opt for. And in that regard, one of the key components in that will be the need to have governance. Consistency of governance cuts through a lot of those heterogeneous, idiosyncratic items that I've just mentioned, and therefore you have a yardstick to then, in some shape or form, drill down across all 35 countries. So in that sense, setting the scene, turning to the E on carbon emissions, optimal ways to invest, tools to invest, engagement and exerting influence through proxy voting, governance, and then if I have a little bit of time left at the end, an optimal team, which doesn't exist, and an optimal performance yardstick to utilize to see if you're doing a reasonable job or not. That's really what I'm going to cover, and that's why you need to cover it in emerging markets, because there's a big lack of natural conformity within the context of 30 plus different regulatory environments. So here we are. Let's kick it off with this one. What is the importance of responsible and ethical investing in emerging markets? Well, it will play a central role in achieving global sustainability if you put governance to the front. Why do I say governance more than the others? Because at the end of the day, governance kicks in with regard to helping your risk return massively, insofar as if you have good governance on data quality, accounting. There are many different ways to account for a goodwill accounting in different geographies. And so by definition, if you apply an international recognition of a GAAP or FASB accounting towards goodwill accounting, it's rubbish. It's not rubbish in, rubbish out for your regressions, or indeed for your subsequent analysis on high quality, or indeed for E, S, and G factors and stewardship. It's actually high quality in, high quality out. So accounting uniformity. First point. Second one would be audit. Checking that that audit and an international recognized auditor who has only 2 terms, maximum 3 terms, and that auditor applies internationally recognized standards regulated locally in accordance with international norms, you have a chance of that high quality accounting standard being not only upheld in a court of law, but actually applied. If that is the case, then you move on. Your data quality is reasonably confident to be of essence. If that is the case, then straight away you have reduced a heck of a lot of the trapdoor fraud, corruption, and inequality risk that's inherent in poor quality data. So audit, accounting, and then I would say the verification of that on a long-term basis. In other words, the separation of non-executives from executives on the boards. Why so? Because then there is no reason, or there's no opportunity for a corruption or a non-conformality of the audit-blessed accounting standards. So these issues go to the direct heart of the factor that you're looking at, which is, can I start with a set of accounts which is clean? And do I trust them? And are they of the right standard? Can they be blessed by my own regulator if they were to look at it? So by definition, it hopefully is more of a science than an art when you have that kind of starting point. So hence governance is a good starting point. Now, how do you enhance the return that you'll get from, let's say, utilizing that clean data in a way which maybe if you buy it with valuation supports at the right time and expect to have a revaluation when the earnings come out in line with guidance? The answer is you get an extra return if you are running a re-rating opportunity from E, S, and G, from active engagement or proxy voting on the underlying ESG factor. The re-rating of that is achieved by a whole host of tools, including engagements, including proxy votes. We'll go into some. But more importantly, to all of what I've said on the governance is that don't ignore the fact that you are operating in different countries, different currencies, different weighted cost of capitals, different regulatory environments, different cycles. So what I'm trying to say is that it is very important to look at top-down factors as much as bottom-up factors in emerging markets. And a classic example in the last 9 months has been the demise of Turkey, which people have forgotten, which was up to 4% of the emerging markets MSCI index a year and a half ago. It's now down to 0.2. Russia is down to 0 from 5%. If your top-down analysis is not there, then you're very likely to have the perfect bottom-up, but unfortunately fall down because you are in the wrong currency, the wrong sanctionable environment, and the wrong divested environment by third-party operators because they cannot stomach the currency risk, the volatility, the cost of capital, or the dearth thereof. So by definition, 1, 2, and 3 is a good place to start in emerging markets. Good governance at bottom up, using the tools of engagements and proxy voting, but overlaying by top down. Next, please. And here you can see when you look at that it is very important to drive that across in terms of the next hurdle, if you like, which is E. E, many people will say, why invest anything in emerging markets when I have to pay twice the underlying CO2 footprint to get the same or maybe lower in the last 10 years, lower Sharpe ratio? And the answer is it's a difficult question to answer. In the context of the last 20 years, the Sharpe ratio of emerging has been better or equal to that of DM, developed world. But having said that, in terms of the CO2 footprint, you would have to be very specific on how you address the E insofar as you do not open up the portfolio to a double weighting of your CO2 footprint. There are ways to do it. An active, sustainable, E-sensitive portfolio can easily do that, not just by exclusion of the heavier carbon fossil fuel components, but also other softer components in terms of the areas such as state-owned enterprises. And so by definition, you can overcome that initial hesitation of investing in emerging markets, higher risk, higher carbon footprint, don't need it. Not true. Quite the opposite. In fact, the risk is the other way, that the developed world is priced for perfection on CO2 and emission targeting, and it therefore will be negatively surprised should indeed it be proven to have a higher one when scope 3 is fully scientifically analyzed. In the context of the other parts of the puzzle here, why not invest through a global versus a GEM mandate? Again, watch out. The developed world is perfectly priced. And so when they do come in to emerging markets and emerging markets gets cleverer at scientifically reporting what they're doing, I think the risk is on the developed world stock, not on the emerging. The emerging is trading at cheap after 15 years of derating and cheap on not having any ESG premium in it. Developed world, quite the opposite. Many times I've seen the developed world stocks operating in emerging and suddenly finding themselves on the front page of the papers down 40% through a labor or an environmental practice which they were unaware of and caught off guard. And they are priced for perfection. They have the downside, not an unknown, unloved emerging market stock. So setting the scene for this, there's lots of diversification for emerging markets. A lot of them now, 9 out of the top 11 are investment grade, and exploiting that sustainable active alpha opportunity in investment grades with consistency of approach with governance and environmental footprint is possible, is doable, and is a very, very large delta upside, given you're not just playing earnings, you're playing re-rating. Next, please. And here the same points I've just made, but at the bottom, advocating on the third point down, active versus passive, because you can get that upgrade from the engagements. And you can offset the risk of some of the sovereign and currency risk by having top-down overlays as well, avoiding the Turkeys, avoiding the Russias. And you can actively engage at bottom up and get the earnings and the re-rating double plus on the upside. That sounds good to me. Next, please. And here, there is no CO2 emissions-led solution to global warming, ex-EM. So even if you want to approach EM emerging markets from the perspective of governance and social issues, it's difficult to avoid the E. Why? Because frankly, there won't be a world if E continues in the rate it's going. And who is the biggest emitter? It's emerging markets. Whether it's in terms of pollution, in terms of CO2 emissions, or water into oceans. It doesn't really matter. So by definition, it is part of the solution by default. How do you approach it? Well, this is an interesting one because it's, as long as it is short, this argument, it's circuitous, it's circular. And in that sense, if you were to say, yes, the blame lies on the emerging markets for the actual volume of exports, if you like, of emissions, then by definition, you'll be ignoring the fact that there's more populace in emerging markets and GDP per capita of emissions is materially lower in emerging markets. And the developed world has gone through its industrializations, emitted a higher base of CO2 into the world, and therefore the responsibility also lies with them to help others subsidize their movement and transition towards a cleaner world. So that becomes a question of money. And that becomes a question of investment grade and political will. And so by definition, this is a very tortuous discussion. The green materials that are used to effect that transition, platinum, lithium, copper, nickel, and rare earths, are primarily in emerging markets. To extract them and to sell them out to developed world to then benefit from the alternative energies that they provide is going to have a footprint. Again, it's a circuitous argument. If you don't extract them, by definition, you can't use them. So by definition, how do you approach this argument? Are you going to approach it in a very exclusive way insofar as BP and Shell in the developed world, sorry, your hydrocarbons, no, you can't be in a portfolio with E, S, and G? Or are you going to approach it in terms of we understand BP and Shell, that all your capex prospectively is going to be on alternatives. You are allocating between 20 and 30 billion bucks worth of really heavy lifting on capex to help the transition. Therefore, you're part of the solution. This is an argument that goes on. And by definition, the state-owned enterprises in developed world, Aramco, CNOOC, Sinopec, Petrobras, are not so good at rotating towards the future. Some are, like Reliance in India. So by definition, if you're going to exclude, do state-owned enterprise exclusion if you like, but be careful on which ones. It's a very much an art as well as a science, this. Next, please. And here is my point. Annual CO2 emissions from fossil fuels world 2021 are growing. And that's sad. China and India, absolute growing. And obviously Southeast Asia. At the same time, offsetting all of the wins from liberal world democracies, EU, Europe, as an example down the bottom. But that's not the full story. Next, please. And there you can see where the critically insufficient plays are. They're emerging markets. And that's primarily up in Russia. Russia, don't forget, has methane and permafrost. As those sinkholes emerge, as the world heats up, methane is ejected, released, and by definition, has a disproportionately powerful negative effect than carbon emissions, or than carbon dioxide. And by definition, it is a very, very tight feedback loop. So the solution lies in emerging. How do we engage to get that end goal? In Saudi, Neom, a modern city that they're building in the top left of Saudi, is an impressive futuristic world that they can go to away from carbon emissions into alternative energy driven solutions. Next, please. And here is the point I was making about if you were to look at the highest per capita emissions in metric tons, it doesn't get populated by emerging markets. It's developed world. So by definition, developed world has to help the emerging world solve this problem. Next. And here is the final point on that. Energy diversification is happening in emerging worlds, especially in China, but so is the coal and the oil increase. But in time, 2030 up to 2040, a meaningful change, 2040 to 2060, a total change. So how many years has the world got of this absolute increase in emissions before the solution comes into play? China is very much part of the solution. It's a leading wind power player, representing 44% and 37% of global onshore and offshore capacity, respectively. It is part of the solution. Next. And here is the final point, which is carbon accounting metrics, back to statistics. As scope 3 comes in, anybody saying I want scientific footprints to actually know what I'm rating from to over date A to date B is going to have problems in emerging markets, not because of the lack of wanting to verify, but the lack of data and the integrity of their data and the collection of that data, especially when you go scope 3 over scope 1 and 2. We have statistics. Our portfolio, as an example, as one portfolio manager, can give you the answer to that. What is our footprint versus an index equivalent? And that is one piece of the solution, but that's on scope 1 and 2. Hopefully not too long before we can do 3, but that's going to come down to emerging markets, data, verification, conformality of that data, etc., etc. So this is going to continue to be a bit of an art versus a science for a little bit longer on scope 3. Next, please. And here is the optimal EM way to invest. I would suggest you go active, not passive. It doesn't really matter if you go style, growth, value, or yield. I would go listed. Why? Because there's a higher level of underlying transparency and therefore third-party verification. Very important in emerging markets. State-owned enterprises, I prefer to run private ones. By definition, it speaks to the higher governance. It speaks to the higher liquidity. It speaks to the higher level of non-executive oversight and stewardship. Exclude or not exclude? Well, this is a difficult one because many people just say on the PRI or the GRI principles of investing, I won't have X, Y, and Z in terms of high fossil fuel allocations and the normal elements of of tobacco and alcohol and munitions. And that's fair. But having said that, there's a lot more to the story. The travel and arrive is the real answer. That's not only from a commercial perspective, but also from engaging to therefore turn people to being a force for good. They want to be. They don't want to be perceived as pariahs. They're willing to help. Engage if you can. People are generally very, very concerned about the environmental aspects. So therefore, if they can help, they will. Next. And here are the items where you really ought to engage when you do engage. And these by sector are very, very important areas on a global aggregate basis. And I've already gone through a few of them. On the right-hand side, halfway down, financials, I was already talking to data security, collection, permissions, retention, transfer, deletions, verification, regulatory oversight, executive oversight, legal alignment. Try and get that through in every single country from Sri Lanka to Argentina to Mexico to Russia, and good luck. You'll be at it all day long. But in simple terms, there is no simple adoption of GDPR or US or autocracies positioning of data. But where you can overlay what you can in terms of going for a stock with an international dual listing, which has to therefore abide by transparency and therefore a regulatory oversight, you can exert some influence. And also you can proxy vote in an unbundling way to the specific item in question. So there are ways you can address each one of these, and I haven't got time to go through them. I've used one as a privacy and a data security, which I think is going to be very, very much in vogue as you go through geopolitical upsets in all these geographies in the next few years. Next, please. And the same could be said for country if you approach the same thing from country. This is a very, very important approach because the ease of doing business in a lot of these countries is very, very different. And union and labor rights are different, and law enforcement is different. And then cross holdings, and then the implications of things such as companies such as chaebol structures, conglomerate structures in Korea, which are intuitive and embedded in the corporate structure, but being weaned off very gently and very slowly over time, as they tend to operate in a family structure, and therefore a minority interest, fiduciary executive responsibility is not primary. Maybe it's the family within the oligarch of the chaebol or the conglomerate, which is primary. So by definition, all sorts of changes in different geographies. Next, please. And here is the way that you can exert some power, what little power you have, or very large collective power if you use it wisely. Share issuance. You could have very, very strict share issuance aspects unless there's very clear, transparent reasoning for that share issuance and not just a blank check. Audit terms. I love that one as an ex-Pricewaterhouse auditor myself. I would go for very strict audit terms and very clear reasoning for change of audit on a rotational basis when and as. Board makeup, non-execs and exec, but not overboarded. Maybe no more than 5 boards. Unbundling of the board issues. This is a clear one. Very often this happens and we have to vote against, where 5 of the 6 items that we want to vote for, but there's one in there which is thrown in cleverly at the end so that you have to vote for the whole bundle of 6 items, but the 6th one is not something that you find palatable. So by definition, vote for unbundling. Transparency of emoluments linked to the corporate goals. Transparency of emoluments is a very big issue, but being able to actually drill down at times to backdoor linkings to emoluments is even bigger. So it's generally a case of going back to that first opening statement. If in doubt, start off with governance, and that's very important. Next. And here are examples and where you can have brilliant engagements and be in the right place at the right time. And as an example, Clicks in South Africa, there was all sorts of issues going on there within the last year, whereby they had an advertising campaign where Clicks is basically a retail outlets chain in South Africa, And this during the politicized last election, which was very closely fought, ended up by having the wrong poster outside of their malls, because they adopted Unilever posters from a global, and there were not enough racially enhanced and balanced people of color in that particular advert. And so by definition, inadvertently, they had adopted a different community makeup in a different country. They hadn't oversighted it internally, and they had put the posters up, and it caused offense locally. And that was not a reflection of the composition of the board, which was 9/10, in this case, black investors and exceptionally impressive executives on their board. They recognized that the error. They recognized also that it was politically induced, but having said that, they apologized profoundly. They beefed up their own internal controls on third-party adverts being pushed through their malls, and they addressed the individuals concerned directly, and showed them those change of controls and registered those controls with a verifiable oversight to the local regulator. That was impressive stuff, and they were already in impressive management, but they were on the wrong side of politics. So by definition, there was an example where people like us who knew them well, who engaged them on the first day of the hit, managed to buy in and exploit that, strangely enough, to an advantage to us, to add into the sell-off. And sure enough, within 6 months, every rating agency had upgraded after they had already assessed the same that we assessed, and it took them 6 months. So you can engage and make money directly. At the same time, if you're looking at Wellspun at the bottom, this goes to the garment industry manufacturing, and can you utilize excess water within that and dispose of that water? And these are leaders in recycling, and they are also leaders in sourcing and verification of sourcing of cotton. So by definition, here is a leader that you really want to encourage to be the dominant player, in this case, towels exports to developed world. And another one down there would be Goldwind. Goldwind was a classic example of alternative energy in terms of clean turbine manufacturing in China. Unfortunately, some of their plants were in Xinjiang, which was where the Uyghur issue occurred. We engaged them on this issue, and they said their robotics was going materially higher as a result of that, and what little labor they had, they were outsourcing it to Mongolia, and they were open to verification on that. Not physical, but it was electronic. But it was better than nothing, and it was a rate of change, and it was an argument which, on the margin, although it needs verification every 3 months, we were prepared to stomach. And so therefore, yes, but. So yes, we are invested in that one, but we are watching it very closely. So there's 3 examples of engagements where you have to be right up at the best, right up at the cliff face to know what's really going on. Next, please. And then the question becomes, what's your process? Is there a verifiable process which is repetitive and alpha generative? And here's an example of a Brazilian mall play. That's another shopping center in Sao Paulo. And here, as you can see on the right-hand side, all the items that we're looking at from an E, S, and G perspective. One of them is below average, which is the red one there, and that goes down to lagging peers in sustainability certification. And so we engage to try and get their property green certification up, and it comes down to their sewage treatment plants and how they can develop technology to enhance that within the context of the limited amount of space that they have. And they have done so, and they are moving in the right direction, and we're prepared to give them 3 to 6 months to achieve that. And that's what they're in at the moment. But from a bottom-up perspective, only one item that we have to engage on, but it's a high overall risk as a result. So that's how brutal we are, if you like, in terms of saying, no, we only want the best of the best. And here is an example where you're falling short of that, and what are you going to do about it? And please verify it so we can monitor it. And that's an example of bottom up. Next, please. And here's the rotational engagement, monitoring, encouragement, either adding or divesting from all of the watch list company meetings that we do, or third-party help from MSCI or ISSS or RepRisk or Bloomberg or CDP, or in the old days, Sustainalytics, obviously, and Robeco. Next, please. And here is the continued stewardship in that regard. You're looking for reasonable care and attention and due diligence to maintain the upside of sustainable value creation. And in that sense, you have a cycle here: and engagement, action, walk away, double up, or engage more. Keep reviewing it. Don't So in that sense, I have a legacy position of probably about 0.5% still in the portfolio, valued at 0. And on a relative basis, I lost a lot less than the index. So relatively, it was a positive, the whole experience. But it's annoying for us because that kind of stock is an exceptionally good one, and not only in terms of its valuation attraction, its yield, but also its governance, community, and its environmental.
Okay. The second question will be China. I think you've been talking about China and also all the environmental things that they're committing. China is highly important in achieving global emission targets. Do you believe that the China's green agenda can achieve it?
Oh, this is a difficult question. I really hope so. I really, really hope so, because if China cannot achieve its agenda, even by 2060, any reductions you've seen in the COP26 in the Western world will be swamped and overridden by the increases or the continued increases of coal and on oil coming out of China and to a lesser extent Russia. And that's sad. So the answer is, since they are so quick at industrializing, and they have leapfrog a lot of the Western world much quicker than people understand, in my mind, they are very much part of the solution. So whether it's high transmission lines where they're a world leader, or whether it's the footprint that they have in world leading in offshore and onshore wind turbines and the technology behind it, they have to be part of the solution, and their growth in these alternatives is breathtaking, and the volume of them, they're increasing. As an example, the biggest wind turbine user in Europe, which is UK, they're increasing its capacity of UK every year. So by definition, yes, they are doing huge leapfrogs in the right direction. But yes, they are definitely still polluting in absolute terms. So if you can somehow engage for them to come down from 2060 down towards 2040, that would be wonderful. We can dream, but you never know. You might be positively surprised. And I think the speed of the technology on advances with AI and industrial expertise and capex centering on centers of excellence might well put China into the forefront much quicker than you think. I just hope they use it as a force for good. They are the center of auto innovation globally. It didn't take long. It took 3 to 5 years to dominate that industry. As I say, high transmission lines and alternative energy on wind turbines, already they're number one. Maybe they could be that on many others too. I think geopolitics is not helping, but I think they have to engage. Otherwise, frankly, we're all sunk. That's my bottom line on that.
Okay, thank you, Tim. And the last question that I have is, in ESG, there's a problem in developed markets related to the data, and more in the emerging market space, so as to get the homogenization and data availability in the ES and G side. Has there been an improvement in the recent years in the data received in these emerging markets? Do you see an improvement in the coming years?
Yes, data is data, rubbish in, rubbish out. And you have to be very, very careful on data when you have different people verifying what the data is and influencing the outcome of that data. Hence, as I started off by saying, you've really got to start with governance and audit. You can't have two books, one not disclosed and one disclosed accounting books. And you can't have data which is non-transparent in emoluments, etc. If you follow the money in emerging markets, you can get rid of the corruption. And so data is critical, and political influence on the data is huge at times, even on areas that I was mentioning in terms of Gini coefficients, such as effectiveness of vaccines, as issues such as ease of doing business. A lot of data suppliers are getting very, very controversial because they're in the middle of a geopolitical punch-up, and there's an element of nationalism entering into these areas, which it shouldn't be. It should just be a clean a measure from a third party. But nationalism has entered into a lot of these verticals that I've just gone through, and therefore data integrity is being questioned at institutional level, and therefore transparency, legality, verification is critical. And data norms, GDPR, US, or autocracies, that do not make it easy because they're not compatible by default. And so that data, if you like, is lagged at times as well, so that you're not quite sure whether you're dealing with apples to apples. And then when you're talking about the verification of data in terms of its retention and then deletion and then regulatory alignment, again, you don't have much confidence at times in that. But where you do have confidence is where I said you do have dual listings. A stock who's got a listing in New York or London or Europe or wherever has to abide by that jurisdictional standards as well. So in a way, that gives you an encouragement to get not only more transparency and update of fresh data, but also confidence in that data. So data, rubbish in, rubbish out. You've got to be very careful at top down and bottom up level, but the rate of change is definitely getting better. Transparency is getting higher. Emerging markets are by default becoming much cleaner. Why? Because emerging markets has cleaned up its act. The top 4 countries in Asia, India, very clean on data. China, Taiwan, and Korea make up 70% of emerging markets. You put the green material countries exporting out from South Africa, Brazil, Mexico, and Chile around that, then by definition, you've got the value plays to diversify, which is good, but they're also, again, very high on data in those markets. Only Brazil and South Africa in the whole of the top 10 of emerging markets are not investment grade, and they're not far off it. And Gulf states in the Middle East, well, they're at a whole new level of GDP per capita. So it begs the question: what is an emerging market? Is it Korea? Is it Bahrain? Is it Qatar? These are all classified as emerging markets. And I think people's perception is that it's Russia, it's Turkey, it's Argentina, it's Romania, it's Vietnam, it's Bangladesh, it's Andean Pact. It's not. All of that lot are less than 1% of emerging markets. So I think data is more likely to be transparent, accessible in those countries I did mention, the big ones, because they want international Western capital in there and they demand data transparency with verification. So a good promising trend. The change in the index helps. Investment grade, 8 of the top 9 nowadays is a very good start. So that's the answer to your question, I think.
Yeah, thank you very much for the answers. I think we have reached the time, so thank you very much, team. It's been really a pleasure. And also thank you to GAM Investments, and also to all of you for attending. And we will keep in touch and see you in the next Sustainable Conference on 16th of June. So take care and goodbye.
Goodbye. Thank you.
Thank you.
Thank you.